Today's speaker is Jon Lieber, Chief Financial Officer at Histogenics. As most of you know, we recently had our New England Innovation Awards. We wrapped it up in May. Histogenics Corporation was one of our winners, so we're very excited to have Jon joining us as our speaker. He has more than 20 years of experience in executive management at emerging growth life sciences companies and in investment banking. He's had multiple CFO roles and has been CFO at Histogenics since July 2015. Prior to that, he was an investment banker for 10 years. He received a BS in Business Administration and Finance from Boston University and an MBA in Finance from New York University. Please welcome Jon Lieber.
Thanks, Susan, and thanks to SBANE for hosting. I'm going to start just by telling you, just for frame of reference, a little bit about who Histogenics is, but I won't spend a lot of time on that, and then we'll go into a little bit about the topic that everyone's really interested in today. So just, I guess, show of hands, a couple of things just before I start introducing just Histogenics for a few minutes. Number one, please stop and ask questions along the way. No one likes to hear, I guarantee none of you want to hear me drone on for as long as I'm going to do it, and I don't want to really hear myself, so if we can make it interactive, that would be super helpful. And then secondly, I guess, how many folks in the room have either been part of a capital raising process, either on the lender side or on the investor side or on the company side? Okay, all right, good deal. So anyway, really quickly, who Histogenics is. We have as Susan said, we're very pleased. We got nominated, and we're very pleased to have been one of the winners of the Innovation Awards just this past May, a month or so ago. We have a product in the late stage. We are a regenerative medicine company. We have a product in late stage phase 3 clinical development. Actually, enrollment's supposed to wrap up by the end of this quarter. And it's a product to treat cartilage repair. And so I don't know how many folks have knee pain in the room, but if you have knee pain, it could be from a cartilage defect. And if you know what a cartilage defect looks like, it actually looks a lot like a divot on a golf course. And in adults, cartilage has no innate ability to repair itself. And if you don't do anything to it, that divot gets bigger and bigger, ultimately leads to bone-on-bone wear and tear, which leads to osteoarthritis and a total knee replacement eventually. And so what we're trying to do is we figured out a way to make tissue, cartilage tissue, ex vivo. Right now it's what we make what we call an autologous cell therapy. So we take your own cells, we take it back to our facility just across 128 in Waltham on Winter Street, and we basically 8 weeks later, roughly, have a living piece of cartilage tissue that gets put back into your body. And what the body has to do, we glue it in with a proprietary adhesive, and then all the body has to do is actually integrate that cartilage implant. And so this phase 3 has been a long time coming. These are very difficult trials to enroll, and so this has taken us a very long time, but we're almost there. We have a 1-year primary endpoint, so about a year from now we'll announce the data from our phase 3 trial. A little more than that, we'll file a biologics license application with the FDA and then hopefully be on the market in about 2 years or so. The market's big. I won't go into sort of the size, we've got, because it's a platform technology actually, we've got a lot of other applications that we can pursue once this product gets approved. So with that, I'll kind of stop talking about Histogenics and move on to the topic at hand. So in all the companies, so I was an investment banker for many years, so I did a lot of, on both the equity and the fixed income side, helping clients raise money both publicly and privately. And then I ultimately took a job at one of my clients, and that was about 15 years ago when I moved up to the Boston area. So I'm originally from New Jersey, and I may be the only person in the room who's not so happy that the Red Sox have leapfrogged the Yankees, but it's a long season, so in any event. Having said that, I will say that the Red Sox good fortunes kind of coincided with my arrival in this area, so I don't know, maybe I had something to do with that. Anyway. So a little bit about, raising capital, and really it does kind of all start with having a plan. So whether you're raising fixed income, whether you're raising debt, whether it's bank debt, or whether you're going out to other lenders to get any kind of debt financing, or whether it's equity financing. And again, it could be from from venture funds, it could be from high net worth individuals, whatever the case may be, you have to have a plan because everybody wants to know. And touching back on what John said about, or actually not John, but what about metrics. I mean, this is actually how you get measured ultimately. So you put a plan out in front of people that hopefully is something that makes sense. And what you're trying to do is finance, at least in life sciences, and I do think a lot of it carries across all different industries, you are trying to finance to some inflection point, basically. And so if you're a business, let's say you're selling, what doesn't matter. Let's say you're a retail business and you're starting out and you're not cash flow positive, you're trying to finance yourself so that you can get to a point where the business is self-sustaining at the end of the day. In life sciences, it's a little bit different. A lot of what we do, candidly, is we finance to some inflection point. And so you go out to usually venture investors and you say, look, I need, whatever the number is, I need $10 million and here's my science, here's my animal data, and what I want to do is $10 million is going to get me to my next valuation inflection point, which is filing an IND, for example, with the FDA, just as an example. And then what the investor realizes is that they can do their diligence, they can look at the data that you've presented, they can, in addition to that, you have to be forward-looking enough to show them that there's actually a market for the therapy that you're developing and that the therapy that you're developing has benefits over some of the other things that are out there and in development, but they could say, okay, I can now make a bet and I can handicap to say whether or not I think this is going to be successful. And then if your data are good and you file your IND, which then enables you in the drug world to go into human clinical trials, then they could say, okay, then the next step would be you fund the company for another period of time, which gets them to another value inflection point. So hopefully each way along the way you're creating value. And I do think that a lot of it is driven by what your long-term vision is. So you have to sort of figure out where you want to be, 10 years from now and work backwards. That's kind of the easiest way that I usually do it. And so that starts with, then having long-term objectives, medium, and then short-term objectives. And then, of course, all those link up to your short-term operating plan and your budgets. And then ultimately you put metrics in place to achieve those objectives. So you want to figure out if you're actually tracking to what you said you were going to do or not, because the last thing investors want, whether it's a lender or an equity investor, is a surprise. They said, oh yeah, well, we thought we were going to get to XYZ without any additional funding, but actually, as it turns out, we're short. And people don't, if you can give people time to get in front of that and you can walk them through what happened and what changed, then it doesn't mean it's necessarily a good thing, but at least you can give them time to process it and work through their internal processes so that they can manage, whether it be their credit committees or if it's a venture firm, their operating partners, et cetera. It gives them time to react and to work with you, hopefully, to figure out how to do it. And so the financing, your long-range plan and your objectives really will define, how much money you need and the type of capital required. And then from that, you basically put together your target investor list. And I say investors, I'll use that term maybe sort of synonymously for lenders as well. And so because I think a lot of the way you interact and a lot of the material that you generate and a lot of the process is going to be very similar, they just tend to have slightly different ways of looking at it. So look, I always tell people, whenever you're looking at financing a company, take a holistic approach and look at all your possible alternatives. And look, not all financing vehicles are right for every company at the end of the day, but you should evaluate almost all of them. So even in a life sciences company that is not cash flow positive, that will be relying on the public markets now, we're a publicly traded company, that will be relying on the public markets to fund it. We do have some debt, actually. We have capital equipment financing. And so even though I don't think debt is generally right for companies of our shape and size, a certain amount of debt can actually be helpful in our sort of capital equation, basically. And so when you think about equity, there's private equity, and there are a bunch of different sources for that listed, some more traditional than others. And I think depending upon what category your business falls into, you would approach different people. So private equity guys would never look at us because we're not cash flow positive, and there's nothing that there's no cash flows that they can fund off of. So we were more of a venture funded company. We actually had some friends and family and angels long before I got to the company. Histogenics has a pretty long history. It's been around since 2002, I think, actually. So So that goes to show you a little bit about, that's not to say that every decision we've made has been great along the way, but it does go to show you how long it takes to develop a product along the lines of what we're developing. And then eventually, if it makes sense for the company, the public markets are another alternative. And the reason why companies like Histogenics went public is because in the end, the capital pools are much deeper. And as you start getting on into later stages, if you're a life sciences company or even a tech company, there's a few reasons why you access the public markets, or a manufacturing company. Number one, the access to the pools of capital are much deeper, and despite how difficult it can be to raise capital in the public markets, it's still easier than privately. You do sign up for a much higher sort of regulatory bar and administrative and regulatory burden, but that's certainly something that at least you know what you're getting into on the front end. And then other reasons just include, candidly, look, employees want liquidity for their stock options, so even if you don't need the capital, you need the liquidity for your employees, basically. And so the only other way to do that would be if you wanted to sell the company, and for a lot of companies that just doesn't make sense for one reason or another at the time. So that's why sort of companies choose to go public. Lots of folks look at debt as well, like I said, and there's a good spot for debt in any capital structure. It just depends how much and the type of company that you're running. And then there's all kinds of other alternatives that people make use of, whether it be government funding, and venture philanthropy, which is something that's actually relatively new, but one of the prior companies I was at was developing a product to treat cystic fibrosis. And so we actually got a fair amount of grant funding from the Cystic Fibrosis Foundation, and so they've actually were one of the first sort of, I would say, charitable organizations that really went into what I'll call venture philanthropy, which is not just funding research for the sake of, they obviously want to fund research to help their patient constituency, but they actually funded it with a business focus of, let's fund it and let's see if we can make some money off of it. Now, unfortunately, our drug didn't quite make it where they and we hoped it would have made it. We had a phase 3 trial that read out in the middle of the financial crisis with data less than we and the markets had expected, and were unable to refinance the company at that point. But they did fund early work at Vertex, and Vertex's product made it to market, and so that's been a huge boon for the CF Foundation. Then what they do is they plow that money back into additional research and development. And so if you've got products where you can find philanthropic organizations, whether it's in the life sciences space or otherwise, that's another place you can go to look. And then lastly, if you've got product rights that you can license, for example, that's another way. And people, all those things sort of fit together in a financing puzzle that I think help enable companies to do things other than just go out and sort of look to raise either equity or debt. Any questions on any of that? Any comments? So in terms of executing a financing, it's interesting. I mean, you're basically, when going back to what I talked about before in terms of your long-range plan, so you're going to have this long-range plan, which then sort of translates into, and look, plans, anything beyond 3 years is probably not so much worth the paper it's written on, candidly, but at least it does give you sort of a guide as to how to get from where you are today to where you want to be. And so what we try to do, and what I've tried to do at all my companies, is really at least you have, knowing that you're definitely going to be wrong, you can create sort of 3 different plans. You can have your base case, upside, downside, and at least that then helps, for example, your investors, whether it be lenders or otherwise, it helps them figure out how to handicap where things are going. And so we start with sort of looking way out into the future. So for a drug development company, for example, it might be, okay, here's how long it's going to take me to develop this product, get it through human clinical trials, and get it into the FDA and on the market, and then I work backwards from there, basically. And then you get to a point where you have your sort of 5-year plan, your 3-year plan, and your 1-year budget, and that's basically what then defines your capital requirements. And so it takes a lot of work, but it's not necessarily rocket science. And so, but it's interesting. I'd say each financing has a separate and distinct process, and sometimes the requirements are the same, and sometimes they're different. It kind of depends. But I won't go through all the laundry list here. But really, what you want to define for your, whether it be your lender or your equity investor, is you really want to basically communicate to them what your strategy is, why your product is differentiated or your service offering is differentiated from other options in the market, how you segment your market and how the market gets segmented, why you're a different, why your mousetrap is better than the other person's mousetrap, candidly. Because in the end, they're making a bet on not only your plan, they're making a bet on you as a management team as well. So I think those two things are really important. And then giving them the tools to understand how you measure your success. So going back to the metrics conversation, how are you gonna define success? Because then that helps them figure out how they should be thinking about what success or not is. And so in the end, it's really it's a ton of preparation, whether you're talking to fixed income people or equity folks, but it's a ton of preparation. And you go through and as long as you're well prepared, generally, and you have a decent business concept and a business plan, most businesses are financeable in most markets. Now, having said that, I just pointed to one example where I had a company that we couldn't refinance at the time, but it was also in the middle of probably the worst financial crisis since the Great Depression. So it all comes down to kind of timing. And the old joke, timing in life is everything, and we hit really bad timing at that point. I do think in a different market, we could have gotten it financed. So the only other thing I'll say is really at the bottom here is no matter what business you're in, the best time to actually go looking for capital is when you don't need it. When you need it is the absolute worst time to go looking for capital, because the terms are going to be far less favorable regardless of what you're looking for. And so in businesses like life sciences, candidly, I'm always raising capital. I never really stop raising capital. It's kind of like running on a treadmill, even when you get your last raise done. And we were fortunate to raise a good-sized capital raise last fall. And we raised $30 million, and that got us funded through our phase 3 data. But even now, I'm still constantly talking to my investors about the next raise. I'm trying to find new investors who might be interested in funding the next raise, et cetera. And so sort of when you're in a business that needs ongoing capital, you never stop raising. So now kind of comes the fun part. So okay, you closed the deal, and now so now what do you do? So remember, look, things go wrong and things change, but in the process of bringing new investors or lenders in, you made a commitment to these people that you had a plan and that you were going to execute on that plan. And so the best thing that you can do is do what you told them you were going to do. And if it's whether it's selling X number of widgets to generate a certain revenue dollar amount, or whether it's getting a drug to a certain point in clinical development, whatever it is, you made a commitment, and you got to do that. And if for some reason you can't do it because things change at times, then like I said before, going back to, it's better to communicate early and often than sort of not. Now, many of the folks, for example, whether they're equity or debt lenders, will have sort of their own sort of reporting processes that you have to go through. So we have a capital equipment line of credit that we used, and so every month we have a report that we have to deliver to our lender that they get. Now, having said that report is pretty bare bones, and so I try to touch base with them on a monthly basis just to give them sort of a general business update and make sure that they're all good and they have the information they need. But it really kind of comes down to establishing sort of communications. And so in the venture world, many of those big investors will actually sit on your board. And so they'll get their updates via their board meeting, but some of them like more frequent interactions. And so as you go through the diligence process with investors, find out from them, what do they like, how do they like to get their information, what do they like, how often do they like to receive communications from you. And we do, and what I found works really well for the companies I've been at previously, we do calls. And a lot of times if we have a board meeting coming up, we just had a board meeting last week actually, so we did calls the 2 weeks before that board meeting with some of our investors that have a tendency to be more vocal in the meetings and have a tendency to maybe may want to take things off track. The idea is you sort of get on the phone with them, hear what their concerns are ahead of time, maybe pre-sell some of the ideas you're talking about, get feedback from them, and it helps the board meeting go much smoother, basically. And so really, at the end of the day, it's sort of, communicate early and often and find out from them what they want. Now, a lot of them would want to talk to you every day, and so there is a balance there. You want to find out what they want, but at the same time, you have to manage them because many of them don't fully understand the difference between what the role of a board member is and a management team is, and so that you have to sort of manage through that. be mindful as you go through your operating plan and your objectives, what the constraints and the objectives of each investor are. And so one of the challenges that you have if you've got multiple venture investors in your company is a lot of them are at different points in their fund cycles. And so so the way they get their money is they go out to other people, they raise a bunch of money, they go invest it, and hopefully they earn a great return for their investors and themselves at the same time. But their funds have actual lives to them. And so I forget how long most venture funds are, but I think it's like a 10-year life on most funds, basically. And so those investors, if you're the last investment out of that fund, their desire to kind of keep funding you, for many more years to come is not as high as, for example, if you're the first investment out of the fund and they've got a whole bunch more time left on that fund. And so what that leads to, candidly, is lots of times differences between investors in terms of what their willingness to continue to fund the company is. And so if you're fortunate enough to have a choice in investors when you're putting your syndicate together, that's something that you need to think about. So as investors are doing their diligence, you're also doing your diligence. So what's the reputation of the fund that's putting the money in? What's the reputation of the partner that's actually going to be sitting on your board? How familiar are they with your space? Is this a new area they're getting into or not? And where they are in their fund life. So going back to that fund life example, if they're at the end of their fund life, the other thing they might be doing is looking to raise another fund, and therefore they might be looking for an exit out of your company that they can then go out and say, look, we made these 10 investments out of our last fund, and we've exited a whole bunch of them, and we've made a lot of money. Whereas the person, the guy or gal who's relatively new and just finished raising a fund may not care about that for the moment. So that really is going to drive, even though they're all supposed to have their sort of shareholder hats on, they don't, their shareholder hats kind of function in two purposes. They have their own sort of holdings, and then they have the broader shareholder hats. And so sometimes that creates definitely differences in how they approach things and their willingness to continue to fund the company. And the last thing I'll say on this, and I think it's actually my last sort of comment in general, is through the diligence process, you get to know these people really well, whether it's a lender or an equity investor. And so what do they like? What's their habits? What are they focused on? What area of the business is most important to them? You could have two parts to your business, two service lines or two product lines, and they may be more interested in one than the other. And that's where, again, you doing your own diligence and understanding what each of your investors is looking for can help you, on the front end, sort of manage your investors on the back end. So the idea would be, look, try and pick, as you do your diligence while they're doing their diligence, that can kind of help you make sure you put the right syndicate together or the right lender in, so that you're not sort of at odds with them once you start executing on plan. And then just going back to what are their internal reporting needs. So I mentioned with our capital equipment lender, we have a very basic sort of, income statement and balance sheet that we deliver to them on a monthly basis. That's really simple for them, and that's all they require. I also then get on the phone with our relationship manager, and I just give him a general update on what's going on in the business. Doesn't take very long. It's a 10-minute conversation, once a month, but it works really well to keep them in a good spot, and it helps him because in the end, he's getting asked. Remember, he or she or whoever it is, whoever your relationship manager is or your venture partner, they have other people that they're reporting back to. So whether it's their credit committee or their limited partners or whatever, they're constantly being asked questions about, how is XYZ company doing, and are they meeting plan, or are they not meeting plan? And so, they have their own requirements that they're trying to meet. And so beyond that, I think that's my last sort of set of prepared remarks, but I'm happy to take questions and open it up.
Could you talk a little bit about what you've experienced with, let's say, two investors? They might have different goals because they invested at different stages of their life cycle. And they might be looking to exit, one may be looking to exit and one's looking to stay in, and how much turmoil that might create based on they're looking to fill their needs rather than the objectives of the company itself.
So it's a good question, and it has happened, and I'm sure I'm not the only one that it's happened to, but we had a situation a couple of companies ago, and I won't I'll sort of leave companies and names, out of it to protect the innocent, but we had 3 investors in the company. One was a wealthy individual. 2 were venture investors. One of the venture investors, both well-known big venture investors. One of the venture investors was the fund was tapped out. They had made the investment in a fund that no longer had any money, and that fund didn't really have a great track record. Most of the investments they made from that fund, it was a very successful venture investor overall, but that fund just didn't do well. And then we had another investor who also was doing fine, but also fund life had come to the end. And so in the one case, we had the angel who had a lot more money, who was willing to put more money into the company and had a very big vision, as did management. But the other 2 investors just weren't willing to go along with that. And so it took, that company wound up getting transacted. That company was sold. But it took a year, actually, for the board to kind of coalesce around a plan that enabled us to ultimately put the company into a process. And it was the only way we got through it, candidly, was just a lot of work and a lot of analysis and a lot of, because candidly, even the individual who had more money didn't really want to put more money in. He just said, oh, you can figure out how to make it work and grow the business, and then we'll sell it, 5 years from now for billions and billions of dollars. And so what's interesting is there it was just over a year, literally over a year, it was constantly working with each of the investors and board members to kind of try to get them to understand, looking at different plans and looking at different scenarios, trying to get them to understand what the future was. And candidly, what it came down to was, look, the company could run out of money, and we could all wind up with nothing, because there it was a cash flow generating company, and we did have debt on the company. It was I'll call it a non-bank financial institution, but we did have debt. And so I said to these guys, look, if we are on our downside case and not our upside case or our base case, the lender is going to wind up owning the company, and you guys are going to be left with nothing. I said, so we have to figure out, either you got to let us go out and raise more capital, none of which, and they didn't want us to do that because they didn't want to suffer the dilution and they didn't have money to put in themselves. I said, or we've got to figure out something else. And so it was just a lot of hand-holding and a lot of discussion. So the question was, and I should have repeated the first question to you, sorry for the videotape. The question was, how is going from private to public complicated our communications with investors? That's actually probably one of the less complicated things about going public. There's lots of rules about your communications as a public company, what you can and can't do, but generally the rule of thumb is that what you say to one person, you have to say to everybody. So if you just kind of keep that in mind, and you put, so that's why companies have sort of forms where they can put their public communications out, and then you stick to the story. And then what you can provide when you do your meetings with individual investors is color around those things that are public, but everybody hears the same thing. What I would say is that maybe a related answer, not specifically to the question you asked, is one of the bigger challenges, though, is running a public company. You don't have the luxury of sometimes not letting information go. So for example, I'll give you a couple of examples. In a life sciences example, you may get data from an important clinical trial, and the data may not be sort of equivocal one way or the other. So if a trial completely fails, that's not a good communication, but it's an easy communication. We didn't meet our endpoint, and the drug doesn't work. Now there may be some nuances around why it didn't work, et cetera, but at the end of the day, it didn't work. Could be a rousing success. You did what you had to do. You met your endpoint, and that's an easy communication. But most of the time, there's gray areas, and so the challenge that you have is that while you're trying to figure out that gray area, you can't talk to investors and give them any information, and then you can get yourself into a little bit of trouble, because let's say you have a trial that didn't meet its endpoint, but it's a little bit you're trying to understand why it didn't, and so if an investor calls you and you pick up the phone, you can't not tell them that the trial failed, but you can't not tell them, and you can't tell them and not tell anybody else. And so while you're figuring it out, you have to kind of buy yourself time, and unfortunately, you don't have a lot of time to do that. And so I think that's one of the really tricky things about being a public company. And then I think the other final thing is just, look, in the end of the day, investors are much more public investors for sure have a much more short-term view of the world than most companies, I think, would like to take and do take. And so that becomes a problem when you're trying to plan for the long term and grow a business over the long term, while still, sort of delivering on these quarterly milestones that public investors like.
I'm curious, and maybe this is a dumb question, if you've ever gone fairly far down the diligence process with an investor and then you decided, I don't think I want to invest in our company.
That's a good question. So that I've never been fortunate enough to have that happen to me, and the reason why I say that is because what that means is generally if you have the ability to do that, you've got something really good, and you probably have a really high an investment that's an investment product that's in high demand, so to speak. And so I've had some fundings that are easier than others, but I've never actually had so many folks at the table where I could say, yeah, we're not dealing with you. Generally speaking, we have on the margin in our last round of funding, we actually did cut a couple of smaller investors out because we felt that they were not long-term holders of the stock, so we did cut them out. But that was their story. But I think I do know of situations though where people have chosen, for example, one venture fund over another because either they were concerned about the specific partner at the venture fund who didn't have a great reputation for dealing with management, or they were concerned about the fund because they felt that the fund took too short-term of a view of the world. And so, for us, we turned down in our funding last fall, we did turn down a little bit of money because we were worried that the investors were more technical. So we did a deal where we sold common stock and warrants to public investors. And in the genre of in the area of public investors, there's that invest in these types of deals. There are kind of two types. There are fundamental investors and technical investors. Technical investors will buy the offering, sell the stock immediately, and hold on to the warrants and hope that basically they'll make their money on the warrants on the upside. And the fundamental investors are more long-term holders. And so there were a couple of those technical people that we didn't sell to because we were worried that all they would do is turn around, sell the stock right away, and that would put downward pressure on the share price, which isn't good for either our existing investors or any of the other new investors. Yeah, so the question was, have I ever been involved in a situation or know of a situation where catering to the investors the needs of, because either there was conflict amongst the investor group or they were just needy investors, for lack of a better way of putting it, that kind of got in the way of running the business. And look, one of the things I do amongst other things is I try to help my CEO manage the board. But interestingly, I think if you talk to most CEOs, those of you who are CEOs in the room that have investors, I would say about half of their time is spent managing their investors, particularly if it's a private company, you've got active venture funds. I would say about 50% of their time is spent managing the investor base. Now, I try to take as much of that off of my CEO as possible so that he can then do the other things that he needs to do. And so we try and share that, but it's a huge time commitment. Now, hopefully, those conversations though are productive, and so what you're doing in having those conversations with them is you're thinking through your own sort of either near-term challenges or long-term challenges. So they're helping management think through some of the different paths forward and plans that you can take. But in some cases, unfortunately, I've been involved in them. They're just a lot of requests for more and more data and details that don't really help advance the cause. In situations like that, unfortunately, I think it does take a toll on. It's a distraction for management, and sometimes it takes a visible toll on the business, and sometimes it's just a question of that you sort of just not to use you just whip the horse a little bit harder, and people work longer hours dealing with these requests. But I've seen it firsthand at some of the companies I've worked at, and when it really tends to sort of present itself, for example, is oftentimes if you have a group of investors who are in the company and you're going out to raise another round of funding and you want to bring a new lead investor in, for example, they want an outside investor to lead the round. I had a situation a few companies ago where one investor sort of was the loudest voice on the board and sort of what I'll call the alpha dog on the board of directors, and they were very concerned that the new investor coming in was going to challenge them for the alpha dog role. And so candidly, they threw up a lot of hurdles to get the deal done, and it was almost like a game of tennis basically. So every time I hit, every time he would ask questions and ask for more analyses, I'd send him back over, the net, and then there'd be more questions that come in, and it really came down to it. It's sort of a battle of wills, basically. I think, candidly, I wore him down, faster than he wore me down, basically. So the question was, while you're private, is there an optimal number of investors, and can there be too many or too few? I don't know what the number is, and it may depend a little bit upon the business that you're in, but there can absolutely be too many or too few. One company I was at in the past had one investor who was a very, very wealthy individual, multi-billionaire, and there are other examples of this out there, and certainly in life sciences. And the challenge is that you are beholden to that individual. And so if that individual, if something happens in the rest of their portfolio that is the source of their wealth, that could be bad news for you as a company. If they're a difficult or challenging investor to deal with, that could also be difficult. In this example, it so happens he was a great investor. He was very supportive of the company, and unfortunately, the business plan and the technology didn't quite come together. But in that case, it was good. But it can be sometimes just investors get tired of, if you're so beholden to one investor and they get tired of funding the company, it can be very hard to go out and find new investors at that point. In terms of too many, you can absolutely have too many as well. Hopefully, if you have a lot of investors, though, there's only a few of them that either A, have board seats, or B, are speaking for the rest of the group. And so there is definitely an optimal number. Too many is too much of a distraction for management and can often take the company. Everybody wants to go in their own direction and explore different things. And that creates lots of just management challenges, like herding the cats. And too few, you become too reliant, I think, and too complacent sometimes. Well, thanks, everybody.